main thing I want people to understand is leverage it high, leverage it long, and ride that sumbitch out all the way. There's a reason why the tortoise and the hare story exists. That's what this is. This is taking the tortoise approach to your business with 30-year fixed loans and winning every single time, and not being get caught up in what the media is sending you, not getting caught up in all the attractive stuff, treating you like a consumer, spending money and going into debt. This is a business. CEOs, the successful CEOs, surround themselves with the best people, and they recognize and basically embrace the fact that they're the dumbest person in the boardroom, and that they rely on other people to know their job so much better than the CEO does, that their job is to just make decisions, very good decisions based on good practical data. And I'm here to tell every person I work with, welcome to being the dumbest person in the boardroom, especially when it comes to finance. You know, I won't say that I'm the absolute best at what I do, but when it comes to me and my team, I'll take Pepsi challenge against anybody who claims that they are.
Welcome to the Wealth Through Real Estate Investing podcast, your source for real-world strategies focused on creating long-term wealth, cash flow, and financial freedom through real estate. Through guidance, tips, and stories of highly successful real estate investors and thought leaders, we provide you the tools to succeed and reach the lifestyle you always wanted. And now your host, Dwaine Clarke.
Hello and welcome to the Wealth Through Real Estate Investing podcast. This is your host, Dwaine Clarke. And today we have Aaron Chapman. Aaron is a mortgage lender with Security National Mortgage Company. He's a veteran in the industry, starting his career in 1997. Aaron is presently ranked number 14 in the industry of over 300,000 loan originators for transactions closed annually. Aaron, thank you so much for joining us on the show. How you doing, my friend?
Thanks, brother. I appreciate you allowing me to come on and talk to your audience.
Absolutely. Really appreciate it. We talked pre-show. You just have a great vibe about you, kind of your approach, been learning a little bit more about your background and your business. And like I said, loved and really appreciate you coming on. But before we kind of kick things on, if you don't mind, for those who are not familiar with your background, to kind of talk about how you got started in the financing industry and a little bit about your current focus.
So the start was rather interesting. I come from a background of cattle ranching in high school, and then working the oil fields of Wyoming after high school. From there, running heavy equipment, driving truck here in Arizona. And then I had an opportunity to go work in the mines. So my dad was a miner all my life, or at least most of it, until we got into the cattle ranching business, which the family partnered with another family and started doing that. But the mine scenario was just awesome. I loved working underground. We'd go 700 feet underground, drill, blast. You're playing with explosives and heavy equipment underground. It was extremely hard work, ridiculously heavy labor, and extremely dangerous, but awesome. You know, and so I loved it. But then they started shutting down that project, and I got let go in late 1997. And I thought, you know, I'd saved up some money. They were paying me per diem to live on site. I was in northern New Mexico. My wife and kid were here in Arizona. And I go back and forth, 13 shifts on, come back for 6, 13 shifts, come back for 6. Well, after the end of one of our shifts, we come up from underground, walked off of what they call the raids, which is like a big old long elevator. And this guy hands me my check and he goes, "Hey, we're having to lay people off, so this was your last night." And so I'm driving back with my dad, that 10 hours for the 6 days off that he was going to have, and I was going to have to go look for another job. Well, I thought, hey, I'm going to be fine. I saved up a couple grand, and I've got a great resume. I'll be all right. Well, turns out my wife ended up having a breast tumor. So there's we were very, very young. I was 23 years old. She was 21. And we had that scare, and insurance denied it. And we paid out of pocket to take care of everything, but it wiped us out. I couldn't find a job. It got to the point where I even tried to get a job driving truck for $10 an hour, hauling landscape rock. And they shot me down, saying I was overqualified. Leaving that location, I'm literally wiping tears from my face. So I'm driving down the road and my gas light comes on. Well, I also had a coupon for diapers for my son because we were out of money and out of diapers. So I drove over to the closest gas station I could find, which had a grocery store there. I pulled up to the pump, swiped my debit card, and I got a decline. So I started rummaging through my truck. I found a few coins, and then I started walking that parking lot for over 2 hours. Found enough change to get 2 gallons of gas. Went into the grocery store, found the diapers that corresponded with the coupon, bought those. As I'm walking out, I come face to face with a guy who used to do all the dispatch work at a company I used to dig swimming pools for. He asked me how things were going, and I explained. He then subsequently took me and my wife to dinner on a gift certificate that he had for Red Lobster. And that's where he introduced me to this industry.
Mm.
So I had to cut a foot off my hair. You know, my mom bought me some clothes that I could put on there kind of business-like, and I went into this company, and they put me on as a telemarketer in December of 1997. And believe me, it was hell getting started. But this many years later, from constant just getting my ass kicked and getting back up, getting beat down and getting back up, where we are now today, I've got a team of 15 people just working on the loans I bring in. I'm the sole licensed loan originator on my team. And I've got the team that is doing all the operations piece of it. And we close over 700 transactions a year. Last month, it was 83 transactions.
Wow.
We're very, very, very blessed.
Wow. So the kind of like the specialty that you focus on, I understand you work with a lot of investors. Can you kind of explain some of the loan programs that you offer and then that you work with, and then kind of talk about kind of the investor programs?
So I started focusing on the real estate investor back in 2003 because I noticed the dynamic between a person buying a house, right, to live in. It's very, very emotional. It's got to be the perfect house on the perfect street with the perfect kitchen, not far from the yoga studio, and life will be perfect when I own this house, even though I can't afford it, but it's my right as an American to have it, right? That was the dynamic we were dealing with. And then I started realizing these real estate investors had a different reason for buying properties. So I really dug in 2003 on. Now, the 2003 to 2008 mess, we know how that worked. But now, from 2010 on till now, things have just really changed a lot. So I do exclusively work with real estate investors. Now, I still do the owner-occupied stuff, the second homes, mostly for my investors and their family, because now they're buying their dream houses and stuff, and it makes sense for them. But what I really focus on more than anything is the 30-year fixed conventional loan, because that's a very unserved, not just underserved, unserved segment of the market. The banking industry does not understand the real estate investor. In fact, you know, the humans themselves are apex predators, right? We're not prey to anything, but each other. What's interesting is humans prey upon each other, and my industry is just riddled with predators. They can't wait to get you to just do what you say you want, and they'll give you whatever it is you want just so you close. And they don't understand what the real estate investor is trying to do for the most part. I can't speak that for everybody, but for the most part, my industry is full of people who just want you to get the deal done so they get paid. And so they will direct people however they need to just to get paid. That's not how we operate. In fact, I spend 10 hours a week making sure that people that call me about, hey, should I refi right now because the rates are lower, talking them down from that thought process because it hurts them more than it helps them. I'll get into that in a bit. But I like to focus a lot on the 30-year fixed. The reason being, have you heard what the eighth wonder of the world is?
No.
So Einstein said it's compound interest. Those who understand it are destined to earn from it. Those who do not are destined to pay it. Well, when a person thinks about a 30-year fixed loan that you're getting, like a loan that you have to pay back over that period of time, that means you're indentured to compound interest for 30 years, right? They're collecting interest on you. One thing that was not factored into this thought process was long-term leverage against a real estate asset in an inflationary environment. Do you know what the rate of inflation is today?
Yeah, not sure what it is right now.
Well, the published number is 2%. Now that comes off of the PCE and the CPI, so the Consumer Price Index and the Personal Consumption Expenditures Index that's being monitored by the Fed. Now the Fed, these different indexes, they only have certain things in them. They don't factor in food costs. They don't factor in energy costs. They don't factor in your taxes. When was the last time you recall paying less per kilowatt hour used on your power bill?
I don't remember that at all.
Exactly. When was the last time you paid less per dollar or per gallon used on your water bill?
Yep, always going up.
When was the last time you paid less per dollar earned in your taxes without tax deduction?
That's even a worse question. It keeps going up.
Yeah, it compounds on you, right? Well, they're not factoring those in.
That's right.
So if you go to a place called shadowstats.com, as in shadow statistics, John Williams, I believe, is a economist. He factors in what he shows is the real rate of inflation nationally. Average is over 7%. Well, then if you look at specific areas, there's another place called the Chapman Index that they look at what the 500 things that people most commonly spend money on in specific regions. And they look at the top 50, or at least they survey 50 metropolitan cities. If you're talking about the Bay Area, it's over 13% in San Jose.
Oh,
Where I'm at in Arizona, it's 8.5%.
wow.
So what is the dollar doing with inflation? What's happening to the dollar's value with inflation?
Yeah, it's keep going down.
Keeps going down, right?
Mm-hmm.
So because of that, we get to raise rents on our properties to pace inflation, correct?
Right, right.
So let's just say a person buys a $100,000 property, put 20% down, finances $80,000, just a regular 30-year fixed deal. They get $1,000 a month in rent. And after all expenses, they're making about $200 a month in cash flow. Does that seem unreasonable?
Mm-hmm.
Seems like in numbers that are pretty accurate.
Mm-hmm.
Well, if you get to raise rents, the national average is 3.6% per year. If you get to raise rents 3% on that $1,000 a month, how much is your rent going up by? At least the rent you're charging your tenant.
I'll say, well, $100 or a little less.
Only $30.
Oh, $30. Okay.
It's only $30, right? It's like, that doesn't sound real sexy, does it? 3% of $1,000 is only $30. But your $200 a month cash flow went up by $30 then, right?
Right, right.
That means the next year you went from $200 a month in cash flow now to $30. That's a 15% growth. And every time you raise rents, it can compound, right? So you're not raising rents on the original rent, you're raising rent on the current rent. So it's a compound growth. But does the bank get to raise the payment on the loan to pace inflation?
Well, they're not supposed to, but is it?
Yeah, on a 30-year fix, they don't, right?
Yeah, that's right.
They accept the exact same payment for 30 years. Even though the value of the instrument you're paying it back with is losing value. So I was theorizing about this same thing on a podcast some time ago. And the professor of accounting at Kennesaw State University reached out to me and says, you got to come speak to my students. So I'm actually scheduled to be out there on the 13th to speak to the students. On top of that, he created a tool with his students for me to use that shows that when you borrow this money for the next 30 years, you're going to pay back the $80,000 plus interest of over 70. I believe it was like $77,000.
Right.
So that right there is $157,000. So yeah, and I think it's probably even a little bit less than that. It's probably about $70,000. So it's right around $150,000 that you're paying back over 30 years. People are saying that's nearly double what I borrowed, right?
Exactly.
So they're freaking out. When you just the nominal rate of inflation of 7% over the next 30 years, and you recalculate the value of each dollar as it leaves your hands to make the payment, and compare it to the value of the dollar the day you borrowed it to buy the property, and you start seeing how that's declining, you're not paying them back 150 plus thousand. You're paying them back about 62 to 64,000 in real dollar value. So what I'm trying to illustrate.
Cash flow to pay it back faster. That cash flow is yours. That's your money. When you give that to the bank, you're advancing them at today's dollar value, not the future dollar value. In fact, how I even discovered, or at least start thinking about this, I had all these investors saying, what about a 15-year fixed loan? Well, what if I just take all the cash flow and pay off the house faster? Well, I started finding when you run the numbers with their tool, a 15-year fixed loan, actually, instead of you giving them back like 62 to 64,000, you're giving them 67 to $70,000 back in real value, because you're giving them more money when the money's worth higher, has a higher value. Giving them bigger chunks at higher value. The longer you stretch it out, the less you pay. And you get to raise rents. You get to continue to compound your income as you're compounding the decline to them. In that world, you're winning. So have you ever seen how often people are refinancing their houses?
Well, I see a lot of commercials for it for refinance. So I don't know if it's a big thing.
It is a big thing. I mean, why do you think that they're doing those commercials and driving people like crazy to refi? Because if you think about it, have you ever seen an amortization table for a 30-year fixed loan? What does that first 5 years look like?
I'm sorry, we're kind of cutting out a little bit.
I was just asking if you've seen when you're looking at an amortization table, have you ever looked at the first 5 years and what that looks like?
No, can you explain?
It's almost all interest.
Yeah, that's right. Yeah.
So you're looking at probably 99+% interest being paid for the first 5 years. There's hardly anything going to principal. In fact, I was just looking at a loan that I bought that my wife bought this property last year, a year ago. And I was looking at the deal today, and the payment's about $500 a month. And it started at a $70,000 loan amount. it's still like $69,000 and like $800. It's only gone down like $200 over a year, even though we're making $500 a month payments. It's front loaded with interest. But if you can convince people to refinance in those first 4 years, and I'm noticing there's a lot of people refinancing every 3 to 4 years, they keep resetting that 5-year interest period, right? So all they're doing is paying these banks closing costs to stay in an interest-based period. You're literally paying to stay in financial bondage. Because I'm telling a lot of my investors who call me and say, hey, shouldn't we refi? Like, no, I've got 6+% interest rate loans that I'm not refinancing until I pull cash out. When I pull the cash out, I want to put that in other investments and grow my businesses. But if I'm going to go and just keep refinancing, all I'm doing is resetting my interest period, and the banks are winning. The longer I hold it and pay that minimum amount, the better chance I have at winning. So set yourself up to win. And if you develop enough equity to refinance it regardless of what the rate is and pull that cash back out and redeploy it into something else that generates revenue, that's when you continue to keep winning. That's, in my opinion, one of the few times that you should refinance. So ultimately, my whole goal is when I talk with a real estate investor about these things, is not that, I know it's maybe helping me get a little bit more excited about real estate. I want them to feel like, to know what goes on between my ears, to know the type of person that they have working with them. I'm not just here to get a loan done. I'm here to ensure that I give them the best information I can so they can make decisions about their business. I look at them as the CEO of their real estate investment firm. A lot of them are buying turnkeys. And if they're in the turnkey world, they're dealing with people who are basically going to be their regional operations division. They got to be sure that those people are good. They got to spend time vetting them out, because if you've got a great team, it doesn't matter what your property is, because that team will be able to keep it rented for you. If you've got a crap team, but you could have a house built out of solid gold brick overlooking the bay, but if their team sucks, they'll never rent. So ultimately, you got to get the right people. And then when they talk to me and I share this information, it's so they know how I think, how I operate, and that when they come to me with questions or decisions that they got to make about their business, they know how I approach things. There's a saying I like to say a lot, that the good judgment comes from experience and experience comes from bad judgment. When I'm doing 700 plus transactions a year, I get to see a lot of judgment at work. I see a lot of people failing. I see a lot of people succeeding. My goal is to offer that practical data where I've seen other people fail and other people succeed with those similar decisions that they have to make, so the client that I'm working with can make an informed decision, not based on theory or speculation.
Yeah, you kind of broke it down really deep, because again, you had mentioned like the front loading at first 5 years is like, I wasn't even thinking about it. And then now, as soon as you had mentioned to them, like, yeah, actually right. And then you mentioned the commercials are encouraging people to kind of refinance multiple times and as quickly as possible. And you're resetting that whole thing, and it's not working out. Should keep that long term, keep it cash flowing, pull out your cash when you can. Wow.
Yeah, and ultimately, it's not the bank's money anyway. This is all Wall Street investment capital. This is pension funds. This is people's mutual funds. This is 401ks. This is IRAs. This is other funds under management going into the mortgage-backed securities. These mortgage-backed securities are basically like a bond. Everybody likes to look at the treasury. So they look at the T-bills to see what's going on with the market or see what's going on with rates. They also see if the Fed lowered the rate. That has nothing to do with this. It's correlated because they all are moving with investment capital. Investment capital will either go into treasuries or some other bond. There's multiple different places people can put their money. You got bonds, you got stocks, you got precious metals, you got other commodities, you've got currency trading. There's all this trading capability. But as they pour money into mortgage-backed securities, that those available funds go up in volume. Therefore, there's more to lend. So the rate goes down, supply and demand. As they pull money out of there and go into stocks, like we just saw in the last week or so, stocks hit an all-time high, right? 27,000 plus. Well, some money had to go from somewhere. And money is an infinite, as a finite resource. Well, it should be a finite resource, but the Fed's good at printing more of the crap. But ultimately, what you're seeing here is it leaves there, and therefore the supply shrinks in the mortgage-backed securities pool. So the banks pulling from that money actually get issued higher rates to access the same funds. So it's a fluid thing, and it moves back and forth. You ever see the movie The Big Short?
Yeah, a long time ago.
So they describe this whole thing. Lou Ranieri, the guy who worked for Salomon Brothers, is the one who's basically attributed as the one who created the mortgage-backed security. there's that scene of him standing in front of in the conference room with the overhead projector with all little houses on it, talking to a pension fund manager, saying, if you invest money with us, we will lend it out. And back then it was like 18, 19, 20%. Then Lou and his team would keep a piece. The pension fund would keep a piece, and they'd pass on some more profits to the pensionee, the person whose money that belonged to. So you can see all that money they're making in the middle. Well, those margins have gotten shrunk and shrunk and shrunk over the years. Then you get into, we could have a whole other podcast talking about quantitative easing and quantitative tightening and how the Fed printing money and shoving into those pools dropped the interest rate so low. There's a lot we can get into, but we also get into how interest rates don't matter because your taxes offset the interest rate. There's so many different things I can offer along those lines, but the main thing I want people to understand is leverage it high, leverage it long, and ride that sumbitch out all the way. There's a reason why the tortoise and the hare story exists. That's what this is. This is taking the tortoise approach to your business with 30-year fixed loans and winning every single time, and not being get caught up in what the media is sending you, not getting caught up in all the attractive stuff, treating you like a consumer, spending money and going into debt. This is a business. CEOs, the successful CEOs, surround themselves with the best people, and they recognize and basically embrace the fact that they're the dumbest person in the boardroom, and that they rely on other people to know their job so much better than the CEO does, that their job is to just make decisions, very good decisions based on good practical data. And I'm here to tell every person I work with, welcome to being the dumbest person in the boardroom, especially when it comes to finance. I won't say that I'm the absolute best at what I do, but when it comes to me and my team, I'll take Pepsi challenge against anybody who claims that they are.
Like that a lot. So is that the focus of, say, single families up to four units, or kind of what's the most of your investors are investing in?
That is about 99% of my focus. I do have a lot of people calling me up about, beyond 10 finance properties and commercial stuff. Well, I have sources for that. I'll plug them into the best people that I know in those realms, because, many people say, why don't you start doing that too? What I found, when you try to be everything to everyone, you become nothing to no one. So my focus went on to just this exclusively, because I want to be just the absolute best and sexiest at this I can possibly get, and let other people who are really sexy at their stuff do their stuff. So the beyond 10 finance properties with a hedge fund, I direct people there. When you're doing with the residential stuff, you want commercial, I got another source who's a commercial broker, and she's awesome. I'll direct you over her, and I'll make sure that introduction happens. But for the most part, I'm going to focus here, because this is where we kick ass and we know it better than anybody else.
I like that a lot. Is your primary focus just Arizona, or, because like I said, we got people like that listen in different markets. Are you also in a select few markets as well?
I'm licensed in 25 states.
Oh, okay.
So we just finished license renewals, the renewal season, and man, it's like 50 some odd hours of continuing education. It's miserable. So for me to be able to keep that going, I have to renew every single year. I think it's close to $5,000 in fees to get it done. And then, of course, all the hours I got to invest in it, but it's worth it, because I try and license myself in all the very good markets for residential investments. If it's not cash flowing well, I don't have a license out there, or I already have a branch out there within Security National, and I'll employ one of those branches out there to help us get it done if it's one of those one-off deals.
Beautiful. Can you kind of talk about maybe some stories of some clients that you kind of helped maybe recently, or maybe some ones that can think off the top of your head that had a scenario that you've been able to help them, and they can they worked out very well for you?
Well, yeah, there was a scenario. There's one scenario that stands out quite vividly for me, of an individual who back in 2017 signed on 2 contracts, same price, same floor plan, same potential rents, same street, both new build properties in Memphis, Tennessee. Now, the only difference between the two is one was just about finished. They're doing all the trim work, getting ready to close. The other one, they'd yet to even break ground on yet. It was just a lot. But he signed these contracts at the exact same price. So we closed the first one in December of 2017 at about 4 3/4 interest rate. That's when Jerome Powell was put in as the chairman of the Fed and started doing what they call quantitative easing. Quantitative tightening. So they did the quantitative easing starting back in 2009. I mean, you're probably familiar with that. The Fed started dumping money into the mortgage-backed securities pool. Through 2009, up until the end of first quarter 2010, they dumped in $1.25 trillion into that pool, into that particular segment of the market. That's over $85 billion a month went in there. So when you got $85 billion a month going in there available to lend, and people weren't borrowing at that point, right? Nobody's borrowing. Not a lot of people borrowing in 2009. What did interest rates do? They went just through the bottom, right? We got that's when rates got really crazy low, and we'd never seen that in history. Well, they kept that up, averaging, you can go in and look where the Federal Reserve actually tracked what they put in. Sometimes it's 40 billion a month, sometimes 20 billion. It was just back and forth different numbers, but billions, double-digit billions going in there every single month. Then you get to end of 2017, doing quantitative tightening. They took their foot off the gas, applied a little bit to the brake, and they stopped investing so much into the pools. So that means they start shrinking. Well, by May of 2018, the second property was done. Well, now you're looking at what the pool is doing, and it's like somewhere, if I remember correctly, I'm going off of memory here. My memory is as long as a hangnail. I think it was doing like $100 million a month. So 20 billion to 100 million. What's that gap look like?
That's crazy.
Yeah, that's the difference between I think probably like the height of a quarter versus the Empire State Building, something like that. I mean, I haven't measured it. I mean, but that's how big the contrast is. So when you consider that kind of a contrast of that much money not going in there, the interest rates jumped a full percentage point. So this investor calls me and he's like, so I closed on my last one at 4.75. Now this one's 5.75. Goes, I'm losing $600 a year. Like, how are you losing $600 a year? Well, he says the difference in the payment is $50 a month. Well, to be exact, it was $49.97. So round up $50. $50 a month difference in payments because that 1% interest on those houses, right? So he was thinking, okay, I'm buying the exact same price, putting the same amount of money out of my pocket, but I'm making $50 a month less on property 2 versus property 1. That's $600 a year difference. He was ready to back out. And he says, but I'm calling you first because you said you're like my fractional CFO, so I'm running this by you so you can give me information so I can make a decision. I said, well, here's what I'd like you to do. I said, I don't have the answers, but this is just what's coming to me right now, is contact your CPA and ask him what's the difference in the taxes you'll pay on property 1 versus property 2, because of the income you're going to make on the higher on property 1 versus property 2. Then ask him the difference in the tax deduction you might experience with the higher interest rate on property 2 versus the lower interest rate on property 1. Then get back. 3 days later, you call me up and say, hey, let's close. I'm like, why are we closing? They said, I talked to my CPA and he looked at, this guy was living in California. So he had some pretty high state taxes. He did very well. Then he looked at, then of course he had some pretty high, 30+% federal taxes. By the time he was done, he said, they ran the numbers on it. It was no longer $49.97 a month in difference in the payment. By the time he filed his taxes and added all the stuff back in, he says he could reasonably see about only $3.55 per month difference. So I took those numbers and I had one of my CPA friends, somebody I do a lot of business with out of Seattle, had her run the same thing, just kind of check it out based upon some generic numbers that were very similar to his, without his data going over there. And she said, yeah, it looks like it might be the case. So what it goes to show to a lot of real estate investors is don't worry about what the rates are doing. We are set up in a world right now that we are the most tax favored asset class on the planet. I say we, because I have investment properties in 5 states. And because of that, because we are creating jobs and creating housing, we get to choose what we want to do with our tax dollars. But if you want to sit on your cooler and drink beers with your buddies and work on your fantasy football league and not do anything else to create jobs or housing, just go and get a paycheck and come home, which is fine to do, expect to pay taxes. Expect those tax dollars to go to building roads, creating jobs, creating housing. But those of us that are already creating jobs, creating housing, we get to use those tax dollars to keep creating jobs and creating housing. That's why the 1031 exchange exists, because once your money's in the system, it stays in that system. Right. But you're also building wealth for yourself. So what you're creating is you're creating the freedom to choose what to do with your tax dollars. And we've proven that time and time again, that interest doesn't matter. All these things that you are being told that you need to be able to evaluate from lender to lender is because these guys don't get involved in the thinking about these things. They don't get involved in how to work your business. They don't even invest in the real estate themselves. What they are trying to do is differentiate themselves with something that doesn't matter because they're pushing you around like a consumer. You're not spending money going into debt. You're a business owner. You need to think like it and act like it. No CEO ever said, hey, how do we get more? They do ask how to get more money in the cash register, but they also want to know, how do we keep it? How do we make more of what we are getting now? And the real estate investors taking advantage of taxes. They're taking advantage of inflation. They're nullifying compound interest with inflation. There's nobody else on the planet doing that. It's completely exciting when you understand what you have available. It's not a cash on cash return model anymore. This is hundreds of % return. The problem is just getting your mind wrapped around it. And that's what I do, is I help you to open your mind up to the realities of things.
Yeah, the way your approach is, because like I said, it just gets you in a different mindset. Because a lot of times when people look at, oh, the interest rates are here, and then they said, I'm not going to do anything. You mentioned sitting on your cooler having a beer. And if you look at it, like I said, from the taxes and, you know, and the inflation, all that, and combine it all along with a sound strategy, you should be able to, you know, get into the game and make it work. So yeah, that hats off to kind of that whole approach is from a totally different standpoint from most mortgage brokers who are just kind of just, hey, I'm just going to do this deal for you. Don't help you as far as any type of strategy or help you with any questions. You go out of your way to help your client to then make a decision where he can be able to take action and then come into a real positive result for it. So I love that a lot.
Well, that one, I pushed away tens of thousands of dollars in revenue for myself in the last couple of months by not doing those refis, even though people are darn near begging. You know, I have to explain to them. I'll spend 10 plus hours a week explaining to them why they're not getting ahead by refi. They're actually hurting themselves, and let them make their own decision, of course. And if they insist on getting that refi done, then I'll do it. I tell them, listen, you're the ones got to fall asleep on your pillow at night and feel good about what you're doing. If I got to do it, I'll do it under protest, but I'll still get it done because I want you going to some other guy out there who's going to take advantage of it. You know, where it's an industry of predators, and I want to protect you from them. But I also can't protect you from yourself. I'll do the best I can.
Well said. As far as kind of like all the hundreds of transactions you do per year, can you kind of talk about kind of the strength of your team and kind of like, you know, how you've been able to develop it and, you know, like just kind of the joy of having a good team around you to have a successful business?
Well, 2014, I was getting lunch for my one employee, which is Ellen Schmidt. She's been with me since 2011, I think, coming up on 10 years. She is awesome at what she does. And actually before that, I think it's 2010, so coming up on 10 years. And I was getting lunch for us over at Chipotle. As I'm standing in line there, and it was in summer in Arizona. You know what the Arizona summers are like. They pretty much suck. And the line was outside the door. So I had to wait to get inside. When I got in, closed the door behind me, right, and let the other people stand out there and get some of that decent air. I have some time to wait. So I started counting the heads behind the counter. And have you ever been into like a really busy, fully staffed Chipotle to see how many people are actually working there?
It seems like a lot sometimes.
What do you think? Just throw a number out there. 10
people, 8 people.
Pretty dang close. I mean, if this was Price is Right, you would have won right there with getting closer without going over. So there was 11 people working there. And I thought, wow, wait a minute. So I see the 4 or 5 up front, you know, doing the tortilla and the beans and rice. Then you got the meat. Then you got the salsas. Then you got that really stingy person with the guac. I don't know if you ever noticed that. They get a big scoop and then they tell you it's an upcharge. Then they hit it on the side and you get the little tiny bit.
Yeah.
Well, then but then you look behind them. There's guys cooking. There's guys chopping. There's guys preparing. There's the manager walking around. Like, this is interesting. They need 11 people to successfully build a burrito. But yet there's only 2 of us in my office to successfully build intricate financial instruments like loans for real estate investments. So I started constructing a team in my mind as I stood there. I needed a tortilla girl. I needed somebody to do the beans and the rice. I need somebody to do the meats. I need somebody to do the salsas. I need that guac person. I need the cash register. I need all the people in the back. And I need to be able to mill around, right, and keep things working. Because as it was, me and Ellen were doing everything between the 2 of us. I mean, there's like 15 steps and we were doing it all. So I started creating it and slowly started adding people to this until now we've got 15 people from the initial phone call. You got scheduled by Samantha, who's my assistant, that monitors all my emails, all that traffic, schedules every single call. I'm on the phone 14,000 minutes a month with her, making sure I'm booked every 30 minutes.
Wow.
I'm blocking my calendar because if it's not on the calendar, it don't happen. Then when I've done with that phone call and the deal comes in, and they fill out their loan application, they go to my website, aaronbchapman.com. I'll tell everybody, if you're expecting a banker website, you're going to be disappointed. What you're going to see is a redneck sitting on the porch of a cabin, which is my office in Missouri. I bought that cabin and turned to an office and leased it back to my firm. It's awesome. So what we do then, you know, what that application comes in, it gets downloaded by my team. Carla or Nicole will review that in great detail, send that person, that potential investor client of ours, a list of the things they need to upload to us. And then they show them how to go about that. So they can log into their file from my website again. Upper right-hand corner says the client login. They go back in there, they log into their file, upload the information to us. It goes in the queue for Ellen, who's my head of operations, been doing this since 1985. She says she did it when she started when she was 1 year old, so she's really young for a person doing it that long. So she will go in and do the pre-qualification. She does a deep dive into all the income and all the assets. Some people kind of balk at it and say, why do you want all this up right now? I just want a pre-qual. Well, my job is to ensure that when we turn them loose to go start making offers on properties, that they're not wasting their time, wasting their money, wasting their energy on something that's not going to happen. I want to be sure it's going to happen. So I put the best person I know to review that paperwork. So once the pre-qual letter is ready to be issued, I'm being given the data to be able to sign that letter, send it off. And I like people, what I want people to feel like is that letter is just short of me sending them a briefcase full of money and they're waiting for the codes to access it, right? We put that kind of time and energy, and it's expensive for us to do that. It's like $200 to $300 per transaction to put those kind of resources into it, but it's worth it to me to make sure people know that we put the time in. Once the contract comes in, I got people that review those contracts because the contract is emailed to us directly at purchase.contract@snmc.com, and that email is monitored. When it comes in, they reach out to all the parties, make sure we have all the accurate data, start the file. Then it gets sent to two gals to start sending out disclosures. It gets assigned to a processor who runs it to the underwriter to get an approval on it, finishes up the file, gets it on the closing. I got the 2 underwriters on my team, 2 closers on my team, people scheduling the signing in the form of actually coordinating with the coordinating with the buyer, the title company, and a mobile notary to be sure that it's done at the convenience of the buyer. And then when it closes, we fund it off of my team, the whole work. So everything is done from the initial phone call to the money going out directly off of my people. So I don't have to call a different department and say, hey, where's this at? And beg for clemency from the manager. I have to see if they can move one along. No, we just moved the damn ball. Exactly. And so we aim to close within 15 days of receipt of clean appraisal. And so that's our goal. And we seem to be hitting it quite often.
Wow, that's beautiful. I love hearing about the systems and kind of everything's kind of flowing. Look like you just, like I said, from a long time and years of doing it, just able to kind of perfect that system. And of course, the clients benefit from knowing that, this thing's going to get done properly, it's going to get done on time, and then they can count on you and your team. So that's awesome. That kind of,
as long as everybody's participating right, then it does get done on time.
Exactly.
The one thing I want to point out, it's not perfect yet. In fact, I'm bringing my entire team in this weekend, the 9th of November. We're going to be all locked up in a room, and we're going to pretend like our industry had a nuke blow up on it, and we get to rebuild how it goes. We're going to rebuild the process from start to finish and look for efficiencies that we may be missing.
Beautiful. Yeah, that kind of answered my next question, which is like, what's a typical day for you? Which is, like I said, the majority of the time work with your team. But do you have any special morning routines that you have before you even get to the office?
So I wake up at 4:30 every morning, and I have prayer. And in that prayer, I learned a lesson about gratitude that I employ into every single prayer. And also things I learned from Napoleon Hill's works. Now, I have a book coming out, actually 4 books coming out after the first year. One of them actually has to do with how I learned about this concept of gratitude and the practical application of it and how that's applied. Then after I'm done with that, I go straight to my chair. I listen to what Darren Hardy puts out every morning on his Darren Daily Thought. And then I go to crack open the scriptures. I'm in the book of Numbers right now in the Old Testament. Then when I'm done with that, I read a segment from Charles Hannell's book, The Master Key System. I don't know if you've ever read that before,
no, I haven't,
but you go through it chapter by chapter. It basically was a correspondence course in 1910. You get a letter with 2 pages in it, and you'd read that through every single morning for a week, and you do the mental exercise that comes with it. Well, now it's a book. You read a chapter at a time for a week, and every day do the mental exercise that comes to really refine your mind and your focus. And then after doing that, I go to, I read something else. I'm reading one of Harry Dent's books right now. And then I start writing. I write books. I write articles for some real estate magazines, and I'm writing content that goes out there on the website, preparing for podcasts, that kind of thing. And I'll write for about an hour, 45 minutes to an hour, or I will edit works time in the middle of it. I got 2 more books that are coming out, and so there's 4 plus the 2 that I'm finishing up. And then I do a workout for about 45 to 50 minutes a day, and then I come into the office. That's my morning routine every single day. Now, Tuesdays, I set aside for deeper thought on the writing and put more energy into that for about half my day instead of just that hour. And the books that I write, I was writing one that was going to be, I actually have over 1,000 pages written, but I decided as I was putting together these books that I'm not going to write 100 pages. It won't go more than 30 pages. I wrote some that are over 300 pages long, but there's a lot of filler in that. I'm finding that I'm wasting people's time with words. Why would I do that? I'm not here to waste time. So the premise of this is to get people to stop wasting time and focus on what's going to get them what they need as fast as they possibly can. So if that's my intent with this, then the books are no more than 30 pages. You better have really good, solid content about the one subject and then move on to the next subject. And eventually when all 10 of them are done, they're going to be able to go out in a 10-chapter book, but it's going to have the same covers in there as your chapter headings. So it's kind of exciting to see how that's going to fly. And if it works, it works. And if it doesn't, who gives a crap? I at least tried it.
I love that approach. Like I said, and it's like it was reading my interview questions because I was asking, what are you most grateful for, and kind of going to a little bit more your spiritual side. And like I said, it's just me and you have kind of a lot of same synergies there, and it was great to hear. So, yeah, awesome. How do we get in contact with you?
The best is always going to be the website, aaronbchapman.com. I have aaronchapman.com as operational as well. But for some reason, Internet Explorer and a few others don't like it. So Aaron B as in boy, Chapman.com is always accessible. We've got, the media page on there. It covers a lot of the podcasts I've been on. This will be on there. There is another segment called Where's Aaron that I write, little things that have happened. I've rehabbed one of those cabins out there. There's a write-up on that. And it's just the easiest way to find me, connect with me. I'll be putting links up for the books when they're available and some other things when I get other things off the ground. Beautiful.
Aaron, it was a pleasure speaking with you. Like I said, getting to know you just in this short period of time that we had on this call. And like I said, it seemed like you're like a great program. Someone that just anyone could just talk to, just easy to talk to. And you just explain everything so easy for people to understand. And like I said, I learned a lot from it. Like as I mentioned pre-call that I'm not a big highly educated on the mortgage side. Like I said, a lot of my clients, they already have kind of people that they know about that stuff, but your holistic approach coming to it is someone that you need, someone need to be speak with you to learn more about it. And so they can be able to take the right approach to their business. So I really appreciate you taking the time and look forward to connecting with you again soon.
Thank you, brother. I appreciate you inviting me on, and I'm looking forward to another time to chat.
Absolutely. Yeah, we're going to definitely dig in some different topics another time. Because like I said, you was kind of going down the rabbit hole there. I was like, oh, we got to save that for another time because you could probably
believe me, the rabbit hole goes deep and it forks.
Awesome. Well, enjoy the rest of your day. Like I said, we'll look forward to connecting with you again soon. Take care.
Thank you, sir.
Thanks for joining us on this episode of the Wealth Through Real Estate Investing podcast. Don't forget to subscribe and leave us a review on iTunes or the listening platform of your choice. Also, please check us out at DwaineLClarke.com, as well as find us on Facebook for more useful content and resources.